Hi everyone, and welcome to BHP Live, our online shareholder question and answer session. Thanks for joining us. I'm James Agar, and with me today is Peter Bevan, BHP's Chief Financial Officer. Welcome, Peter.
Thanks, James.
Today's about connecting with you, our shareholders, to answer any questions you have about BHP, whether it's about our most recent set of results or whatever else you might have on your mind. Before we go to the questions though, I'm going to ask Peter to briefly take us through our recent half-year results and provide some context on how BHP is performing.
Thanks, James. Well, it's great to be here and have this opportunity to speak directly with you, because you represent the people who've chosen to invest with us and in many cases have a long-standing investment with BHP. You have an important stake in our future success, and understandably, you want to know how we're tracking. And just on that, as James mentioned, we recently released our half-year results, which show that we've had a good start to the year. We've benefited from higher commodity prices, but most importantly, delivered a solid operating performance. And we're on track to carry this momentum forward into the second half and beyond. So here's some of the main points. Our profit is up 25% to US $4.1 billion. Our free cash flow, which is a measure that shows how much cash we have after we've paid our regular expenses and invested in our business, was almost $5 billion. That's allowed us to reduce our debt and give more money back to you, our shareholders. And if we take a closer look at that, your dividend for the period is 69 Australian cents per share. And this means we will pay out almost 4 billion Australian dollars in dividends, our third highest ever. To achieve these results, we've consistently executed our plans, which include three main focus areas. And the firstly is to maximize our cash flow, which means we're working to generate more cash through things like running our operations more efficiently so we can invest further in the business or return cash to shareholders. And secondly, to maintain capital discipline, which means we're making sure each and every dollar is invested wisely. We do this through what we call our capital allocation framework, which is a process that guides our approach to investment and returns. And finally, to increase value and returns, which means, and you're probably picking up on a theme here, to increase the value of your shares and to return more cash to you. So that's a brief overview to get today started, and I welcome the first question.
Great. Thanks, Peter. We've got some great questions coming through. The first one I'll ask is from Paul. Paul says, congratulations to everyone at BHP on a great start to 2018. Mm-hmm. Can you give some numerical guidance or commentary about where the second half might be heading and where you think 2019 may take BHP?
Solid first half. I think you should expect a second half which builds on that. I think that we have got more opportunities to squeeze more volumes out of our existing assets and to further reduce costs. And so for this year, we should expect to see that we will increase volumes by about 6% on a copper equivalent basis and, as I say, actually further reduce costs. So if you put that performance together with, in fact, the prices that you sort of see on the screen today, this is spot prices, and they will do whatever they do. But if you put that performance that we're expecting with those spot prices, then we have the possibility of making an additional $7 billion for the second half of this financial year. And that's in comparison to the 5 we've already delivered for this year. So let's see what happens with both prices, but hopefully we can deliver that sort of thing.
Great. And 2019, Peter?
More of the same. 2019, we've got more opportunities, again, to further squeeze more volumes out of our existing operations. There is, in fact, more costs that we can take out. We've done $12 billion of additional productivity savings over the last 4 years. We've more or less halved our unit costs, but in this financial year and the next financial year, we have the possibility of adding another $2 billion additional productivity to that we've already delivered. So lots of hard work to be done. It is getting harder. low-hanging fruit's been picked up, but that's what our plan says.
Great. Well, Peter, you said this is about direct engagement with our shareholders. Rachel gets straight to the point here. What's the outlook for dividends?
That's a great question. I'm sure a lot of people want to know the answer to that. Look, what I can say is that obviously the outlook for dividends is entirely related to how well the company performs on the things that we control, but also very much on the things that we don't really control, which is, of course, price and FX. But the world is a relatively benign place at the moment. The operations are performing very well. So we'll see when we get there. But what I would also say is that let me explain the dividend policy a little bit. We have this capital allocation framework, and what it says is that we generate a lot of cash here. So how do we deploy that? Well, the first thing we've got to do is we've got to put it to work in maintaining our business. So we have these existing assets, we need to look after them. Second thing we need to have is a strong balance sheet. Our balance sheet today is way stronger than it has been over the last few years. We've paid down a huge amount of debt, and we are inside of the range that we want to be in. Probably we want a little bit more off the debt, but we are inside of the range where we are today. So then we have a dividend policy that says that whatever our earnings are, we will pay out 50% of those earnings in cash to shareholders. So that's a given. If there is additional excess cash over that, that will then compete between investing more in the business for the long term, for value obviously, and between additional returns to shareholders. And so what we've been doing, as you've seen in the last couple of periods, is in fact maintaining the business, strengthening our balance sheet to the point that it's inside the range. We have continued to invest well in the good projects, and in fact we have been giving back more cash to shareholders than that minimum payout.
What was the payout for the recent half?
Well, the payout, in fact, for the recent half was, in fact, the half that just closed was 72%. So I say minimum dividend 50%, but we're very motivated to give cash back to shareholders, and that's the reason why we had, in fact, 72% payout.
Great. Thanks, Peter. Sticking to the dividend, I've got a question in here from Milton. Milton's been a BHP investor for many years, and he asked, is there any talk of a dividend reinvestment plan in the future?
This is a little bit more than talk, happily, I think. I mean, DRPs are something which I think are very important to our shareholder base, particularly the retail shareholder base. We haven't had one, and we've been listening to folks who have been asking for this. So happily, we will be, in fact, offering a DRP for the next dividend that we pay. That's the one that we declare in August. A DRP is a relatively simple thing. You can elect, in the event that you wish to not receive a cash dividend into your bank account, but you can elect to have us take your cash dividend and buy BHP shares, and we will send you the BHP shares instead of the cash, and we'll do that very efficiently for you. But that's entirely at your election, as you wish.
Great. And when's that going to come into effect?
For the next, the final dividend of this financial year.
Got it. Great. Okay, Gary, now this is a topical one in the papers today. Please update us on your plans with the shale oil assets.
Very important topic. Look, we've got the shale assets. The data rooms are now open, so that means that that's all the information that a bidder needs to assess in order to make a valuation and obviously hopefully make a bid. It's a complicated process, but they're underway. So we would expect to see bids probably about the middle of this calendar year. Now, there'll be a lot of bids for a lot of different parts of this business, very, very large business. Happily, there is also a lot of interest, so there will be a lot of people who will be giving us, hopefully, bids, and so it's going to take a little while to sift through that and actually complete the transaction and receive the consideration, and that'll come at the end of the financial year, probably, something along those lines.
Great. All right, I've got a question now from Roger. Roger says, what's happening with Samarco, and are there any damages pending against the company in relation to Samarco?
So the Samarco tragedy occurred probably 2 years ago, and so in those 2 years, we have spent a lot of time and a lot of money on making things better. And so we have got a lot of progress on the restoration of the environment. We've got some, I think, some excellent pictures that you can go to our website and take a look at. There is still a lot of work to be done. The other thing which we have made good progress is on compensation of the people that were impacted by this. We've paid out almost 260,000 people in some form of compensation. This was, water or other issues. We still have, again, more work to be done. We have 2 towns that we have to rebuild, and that is moving ahead. Still a lot of admin and so on that has to be done, but that's making progress. So I'd say that we have provided $1 billion for this, and I think that's about the right number, as we know today. But there is some uncertainties around this, and so this will play out over quite a long time. But as I say, we will stick with doing what is right here until it is done.
Great. All right, another topical one here from Fiona. There's been a lot of talk in the media about BHP potentially combining its UK and Australian holdings into one Australian listing. Fiona wants to know, is this something we're looking at? And in your view, is it a good idea?
Yes, that's something we are definitely looking at and have looked at it for many years and will continue to look at. Let me maybe just a quick setup. We have in this BHP has got something called a dual listed structure. We have 60% of the shares are actually in limited. It's listed in here in Australia. 40% of our shares are actually listed in the UK in a PLC. And so it's a little unusual. Rio Tinto has exactly the same setup, but it's been around for a long time, and it's actually worked very well for us up to this point in time. But we do think about whether there are some benefits from collapsing the PLC into limited and actually having only one register here. But what are the pros and cons? Well, the first is that we only run one company, and so there isn't a big simplification benefit from collapsing the DLC. There isn't 2 overheads or 2 CFOs, thank God. There is what we have. So there's not a real pot of gold there. There is, unfortunately, some costs that will associate from the collapse, and they're really around tax. And here in Australia, plus some stamp duties, that is more than $1 billion. So it is material. It's probably, it is reducing, but at this point in time, it's $1 billion if we were to collapse today. So what's interesting about this idea is really around the use of franking credits. We have built up a large store of franking credits because we are very profitable here in Australia, and in fact, because the DLC exists, because we only pay franking credits to Australian shareholders, and so because they're the ones who can value and use these, and the 40% of the PLC dividend doesn't have a franking credit. So in fact, we have saved for value for Australian shareholders a huge amount of these franking credits. Now, they exist and they are not fully utilized. So the way to do this is to bring more Australian registered shareholders onto the register as a whole. And the way to do that would be to collapse the PLC into limited, have one register. So if you did that, there would be non-Australians out of PLC that would sell. They would have to sell. They would come onto the limited register, and there would be more buying out of Australia, probably from the institutions. And so good, we've ticked that box. We've got more Australians on the register. But we've now only got one register, and so there will be a bunch of folks from the PLC register, in fact, who will sell, but there will be some that won't sell. They will have to find their way onto the limited register because there's only going to be one. And those folks will now receive a franking credit with their dividend. They don't value that, and so the share price now has to find a place where you have more people on the limited register that are receiving a franking credit that they don't value compared to today. And because of that, there is a possibility that the limited share price might fall because there are more folks that on the register in the future that don't value that franking credit. So it's a little complicated.
Well, perhaps if I just stop you there, Peter, because that is a question that we get year after year, ever since the two companies came together as part of the merger, is why does that limited share price consistently trade at a higher level than the UK share price?
It's majority of this is about franking credits. So what we have is we have the PLC share price, more or less at a 10 to 15% discount, day in, day out, since the inception of this merger, 2001, 10 to 15% lower than the limited share price. And that's because the limited share price reflects the value of the franking credit that you receive here in Australia. And the same thing, we don't give it to those folks in the PLC, and that's a good thing because they don't value it. And if you did give it to them, they wouldn't value it. So as you bring them on, the share price has to find a home between these two, the current PLC and the limited, and probably it finds a home like that. So, just to try and wrap this thing, there doesn't appear to be. We're pretty sure because we know our business. We know there isn't a massive simplification benefit. We only run one company. There are considerable costs, and the franking credit issue is very interesting. But at this point in time, we think that there are uncertain benefits versus the costs from the franking credit. So at this point in time, probably let it be. But we'll continue to review it as we go forward.
Good. Okay, well, changing gears now, Peter, we've got a question in from Jane, wants to talk about the outlook, specifically China. China's obviously a very important country to Australia, but also to BHP. What's your outlook there, and what's that outlook going to mean for BHP in the future?
Well, I think we've been consistently positive about China, and that's been a good call, clearly, and nothing's changed. I think we are still very confident in the ability of China to continue to grow. It will grow at lower percentage growth rates because the economy is so much bigger. But because the economy is bigger, we still see very strong demand, increase in the demand for the materials that we are producing. That's good for BHP, and that's good for Australia. But I think what's been very interesting is that China is starting to really strongly emphasize the fact that they cannot simply grow at all costs. They have to grow sustainably. And so what they have been introducing with great effect, in fact, over the last year, is some reforms in their own economy to improve the environment, make it more sustainable. So what have they done? They've taken the dirty, high-cost part of their steel industry, their heavy industries, and they have shut them down, essentially. And that's the way they can do things. So what that does, it means that the margins have gone up for the rest of the industry that remains. And so because they are able to have higher margins, they are demanding, in fact, more of the product that we produce, which is higher quality product. And so we have seen not just an increase in demand for iron ore or met coal in general, but in fact an increase in demand for the high quality iron ore and the high quality met coal that we produce. So we are in fact the double beneficiaries of this. Plus, of course, it's more sustainable, which is good for everybody. So that's been a very interesting part of what's happened in China.
Good for BHP, good for Australia by the sounds of it.
I think that's absolutely right, yes.
All right, well, we'll stick to the outlook. Another commodity-specific question. This one's from Derek. Derek says the world is moving away from carbon-based energies like coal and oil.
Sure is.
So how much does BHP expect its carbon-related businesses to make up in our future earnings mix?
Sure. Look, our hydrocarbon business is really oil, gas, and of course thermal. We haven't got very much thermal, but we have some of that.
Thermal coal.
Thermal coal, yeah. Sorry, yes. Look, we're very aware that the world is, of course, moving away from carbon. We're a believer in climate change. There's no question about that. But the reality is that there are more people in this world, and the standards of living are lifting, and so the world is going to need more energy. And so even though you're going to get more renewables and so on, in fact, we think that there will still be an increase in demand for oil and gas and even for thermal for at least the next decade and probably beyond. And so our business, our hydrocarbon business, is still going to be very good for us in that time period. Beyond that, it is a little bit more interesting, but that is in the very long term. And there is cases to say that the prices for those goods remain strong. There's also cases to say. But what we have in BHP, of course, is a portfolio. And so what we do know is that we have a very strong copper position, and copper exists basically to transport energy. So it's pretty clear there's going to be more energy in the world, and therefore there's going to need more copper. And we got this tremendous copper business, and it can only get better. And then, of course, we've got the other part of our business, which is carbon steel materials, met coal, iron ore. That should remain strong because it's not affected by this particular issue. The other one in our portfolio, I think a very interesting thing is that we have potash. Now, potash is a fertilizer, and so its demand is also, we think, going to be very strong in terms of its growth. And that's because, again, there's more people, they need to eat, they would like to eat better, and the amount of arable land is either going to stay the same or it may even get less. So you need to get more out of that arable land, and the way you get more out of arable land, you have to get higher productivity, is you need to use more fertilizer. So we've got this great position in Canada. It can produce the lowest cost potash in the world. And so we're thinking about whether we should start producing, have a project in that part of the world. And again, that would be an interesting adjunct for our portfolio in the future.
Option for the future.
Option for the future. It has to go through the capital allocation framework, and it will only be executed in the event that it has good returns for shareholders.
Great. Well, I've got another question here, from Stuart, talking of commodities of the future. Stuart says electric vehicles seem to be the way of the future. Is your portfolio set up for this? I think you've spoken how we'll benefit from our copper exposure.
Yes, that's the big one.
Stuart specifically wants to know if we'd consider getting into lithium.
Yeah, look, again, copper's really the big one. That's a very large market, and it's going to get bigger, and we've got this great position. Now, lithium and cobalt, for instance, was another one. There's no question that the growth rates in the demand for those, they're very small markets today, growth rates are going to be very high. No question about that. But the thing that we concern ourselves a little bit is two things, really. One is there is a lot of lithium around in the world. And so you can have very high growth rates, but if you have in demand, but if you have a very high growth rate in supply, you may not find the price goes anywhere, and you invest a whole bunch of money and you really don't go anywhere. So we're very thoughtful about that. And the other thing is that lithium is a small market today, and it's going to grow fast, but it's still going to be a relatively small market in the future. And so BHP is a big company, and we need to do big things. And so that's also something which we're just a little bit thoughtful about. But the whole battery thing and in the way the world is moving, as I say, we're very thoughtful about it. And there's many ways for us to play in this. And so I think we are reasonably comfortable. Very thoughtful, a lot of work and thought going into this, but I think we should be good, I think.
Very good. I think there's a great question here for the CFO. You'll like this, Peter. Straight to the point, again, like Rachel's dividend question. James asks simply, when are you paying off your debt?
So we have paid down a huge amount of debt. I mean, we reduced our debt further in this last 6 months. The last year, we paid down $10 billion. We are inside of $15 billion of net debt today. Now, James, that's a big number, no doubt. But this is a very big organization. So when you look at gearing ratios and you look at cash flow to interest ratios, those sort of things, I think that's a very comfortable place to be. We think that the net debt should be somewhere between 10 and 15 billion in the medium term. That will protect us from any downside that we can see, because the world is an uncertain place and we need a strong balance sheet that will look after us. But in the event that we got into a really difficult spot, we would also, in fact, be able to invest in something. In other words, be counter-cyclical, take advantage of opportunities that may throw up from distressed sellers and so on. And we think that 10 to 15 range is about right. We're inside the range, we're at the top end of it. We still probably need to put a little bit more away for a rainy day. It's just a prudent thing to do. We're producing a lot of cash. we should just put a bit more of that away. But we're very close now.
Very good. Well, look, I think we've got time for a couple more questions. We're nearly up on the half hour. This one is from Blake, who's read a lot also in the paper this week about corporate tax. What does BHP think of Australia's corporate tax rate?
Lots of debate going on. And that's a good thing, by the way. I think we should have more debate about tax as a whole, in any event. What do we think? Well, let me just bring maybe a slightly narrow perspective, but I think a very important perspective. It's simply that Australia's, or any country's, tax rate needs to be competitive. That's what I mean by competitive. They say, look, Australia, since its inception, has built this amazing country on capital investment. And in order to attract investment, you have to be competitive in returns. In other words, money will flow around the world wherever it can find the highest return. It's a simple premise, and I think it's stood the test of time and will be the case in the future. One of the key aspects of returns, of course, is the tax rate. And so if you have a higher tax rate, that obviously means that returns are more challenged, and you have a higher, well, it's harder to win the competition for capital. Converse is true. Now, the other issue for Australia is that we have a 30% corporate tax rate. Now, the rest of the world is reducing their tax rates. So all the other countries that we compete with, and it is a flat-out competition to attract that dollar of capital, which can go anywhere, they're reducing their tax rates. Now, the US has just reduced its tax rate from 35% to 21%. The UK is now at 17%. And so a lot of countries are moving down, and Australia is still. So we are now very high in the league table of OECD countries. And I think that is something that Australia needs to be very thoughtful about, because there is so much more that we can still do here as BHP, but as a country, but it does need capital. And that capital needs to come from inside of Australia, but as it's been since the start of Australia, of course it needs to be attracted from outside as well. So I'm not here to say we've got the grand solution of how the tax system should work and how the politics should work. But what we are saying is, simple premise, if you reduce the tax rate, the chances of attracting scarce capital to Australia and therefore being invested in all the things we need to invest in is higher. And that's a debate that's worth having, because it's good for Australia. It's good for the workforce in Australia, and of course, it's good for BHP. And all of those things are wrapped up in the same place.
Great, thanks, Peter. Well, I got last question here. We're running out of time, and this is going to be a difficult one to wrap up into a concise answer. You'll have to go on a bit of a wander here, but
well, you know that's dangerous.
David asks, what do you think is BHP's greatest opportunity? And in contrast to that, what keeps you up at night?
Okay, greatest opportunity. Well, I'd say this is a personal view on this, actually. I think that BHP has been around for, 130 years, and we've showed the history of BHP. I feel the personal accountability to continue the story that has been. So we need to be able to keep BHP in the shape that it has been for all these years. And that's the near term, the medium term, and the long term. And I think that's a heavy responsibility, but I think we have the wherewithal in this company to do that. It's not easy, but it's very exciting and it's very rewarding at the same time. And so that's maybe just a personal view on that. Look, what keeps me up at night? Well, two things really, and anybody in BHP is going to give you the first answer, because this is the way this place works. The first is we need to keep our people safer than we've had. We do a great job on safety here, but we still have accidents, and we need to get those out of our system. We run for long periods of times. We don't hurt anybody, and we just need to make those periods of times longer and longer and longer until we finally exclude any possibility of fatalities and serious injuries. The second thing which keeps me up at night is, of course, the world and China, and there is a lot of interesting things happening at the moment, and Trump and so on, and North Korea and so on. So I think that those are things you can't control, and I really shouldn't stay up at night worrying about things I don't control. But
you're not alone, Peter.
Yeah, that's another little problem. But in the event that those things happen, BHP needs to be in shape to manage those things. And so we need to have a strong balance sheet. We need to have low-cost assets that will survive any price deck. We need to have great options that we can continue to grow value for very small amounts of capital. And I think we are in that place today. We've got a little bit more work to do on the balance sheet, but I think that, look, I'll stay up at night. You all should feel comfortable that I think this is going to be a very good investment for the very long term.
Great. Well, thanks, Peter. That's all we have time for today. Is there any final remarks you'd like to add?
James, I think, look, solid set of results for the half year. We've got our work cut out. It's always like that. We've got to do better in the second half, but I think we've got very good progress here, and we're making a lot of cash, and the balance sheet's in a great place. We've got good projects getting invested in today, and of course, we look forward to continuing to reward our shareholders with cash dividends.
Great. Well, thanks again for joining us, everyone. We hope you found it a useful session, and we look forward to doing it again soon. Thank you.
Thanks, James.
Thanks, Peter.